answering your questions about retirement. It's Money Talk with Michael Eastham.
I want to leave something behind for my kids, but I'm worried about taxes. What can I do to make sure they keep most of it?
Well, I get a lot of questions about taxes to beneficiaries and things of that nature. How do you keep the most money intact for your heirs? Well, the first thing I want to make sure that you understand is that there's a difference between inheritance tax, or what many people refer to as the death tax, and taxes on things like IRAs. So the first thing that most people think of is, well, there's going to be estate tax. Well, for most people, that's not going to be the case. And this has just recently been adjusted under Trump's new Big Beautiful Bill Act, because the exclusion for estate tax is $15 million for individuals, $30 million for a married couple. So if your estate is under that $15 million or $30 million limit, you don't have to worry about estate taxes at the federal level. That may not be the case in the state that you live in, because every state has different laws regarding estate taxes at the state level. So not to be confused there, but you got to understand there's a difference between federal estate taxes and state estate taxes. At the federal level, if you're under that $15 million or $30 million estate value, you won't pay estate taxes at the federal level. You'll have to check with your individual state to find out exactly how that might affect you. Now, let's talk about the second part of that. When the types of assets that you have are going to have an impact on the taxes that are paid by your beneficiaries. So, for example, if you have IRAs that are going to get passed on to your kids or grandkids, well, there's no way around them paying taxes on the inherited value of those IRAs. So it's just going to get taxed at their highest marginal tax bracket. So in many cases, this is okay with folks, simply because of the fact that a lot of times the kids are in a lower tax bracket. It doesn't affect them nearly as much. But you'll have to check with your individual situation to ensure what that impact might be. Talk to your CPA as well. That's always a good place to go. And you will realize that certain types of beneficiaries will have to take that money out of the IRA within 10 years or by the end of that 10th year. So there's no required minimum distribution at this point, like there used to be on inherited IRAs. That's gone away. You do have to take money out by the end of the 10th year, which means that your beneficiaries could mix and match. They might take a distribution this year, and then next year they might not take a distribution. But the bottom line is the IRA has to be empty by the end of that 10th year. So be aware of that so you don't get hit with a big tax bomb. One way that you may be able to avoid or at least reduce some of the impact on your beneficiaries is to consider a Roth conversion for a part or all of that IRA. That could be beneficial as well. So, of course, the numbers are going to dictate whether that makes sense for you in your situation, but that's another option, especially on IRAs. Let's talk about non-qualified or non-IRA annuities for a minute. A lot of people think that they're going to pass on an annuity and their beneficiary is not going to pay tax on the value of that annuity. Well, that's not the case. The IRS very specifically states that with a non-qualified or non-IRA annuity, your beneficiaries will pay tax on any gains that have been received inside of that annuity. So, for example, if you bought an annuity, you put $100,000 into it, and you've held it for 25 years, now the value is $250,000, well, your beneficiaries will pay tax on $150,000 of interest that's been credited or gains that have been credited to that account when you pass away. You're not going to be able to avoid that one. There are some possibilities of extending that over a several year period of time, but that depends on the insurance carrier and the type of product that it is. Okay, so lots of things to consider with respect to how do we optimize taxes, one of the benefits that we have here at Fellowship Financial Group is that we have integrated tax and accounting into our financial planning services. So we certainly can help you do some proactive tax planning from an estate standpoint and make sure that your tax strategy is intact, supporting the goals and dreams that you have for your retirement and for your beneficiaries. Thanks so much for that question. Make sure you like and subscribe to get updated and relevant content every single week. Thanks so much.